Welcome to Be It Resolved, Season 2, where bold ideas meet courageous leadership. I'm Rahul Bhardwaj, President and CEO of the Institute of Corporate Directors in Canada. Each episode explores the issues that influence directors, governance, and decision-making in the boardroom. And my guest today is Peter Dey, Chairman of the Advisory Board of Paradigm Capital, but just as importantly, he's had a long and very storied career in corporate governance, serving on many public company boards and as chair of the Ontario Securities Commission. He also led the Toronto Stock Exchange Committee on Corporate Governance that prepared the very well-known 1994 report titled, Where Were the Directors?, better known as the Dey Report. Welcome, Peter.
Thank you. Happy to be here.
Great to have you here. Now, today's resolution is, be it resolved, boards need a culture shift to bad news early to meet disclosure obligations post-Lundin. Now, which way will you vote? I ask our audience. And Peter, you'll get a chance to vote on the very end of the show today. Let's do a little bit of a setup for those particularly that don't know about Lundin. Today, we'll look at how directors should be thinking about material change and disclosure following the Supreme Court of Canada's decision in the Lundin mining case. The ruling is renewed attention on when a material fact becomes a material change, triggering immediate disclosure obligations. Public company directors can expect some increased scrutiny around timely disclosure. And today we're going to talk about what directors need to know about that. Peter, let's start off with Lundin. Hasn't even been tried on the merits. Why should boards care about statutory interpretation?
Boards always care about sitting on a board of a company that's accurately valued in the markets. And accurate valuations depend upon the quality of information that's available in the market about the company. So boards should care about any development, whether it's legal or social, that impacts their responsibility to keep the market informed. And we hear constantly about the asymmetry between the information that management has and the information that the market has. And I think every director should be thinking about that asymmetry and how not just legal changes, but generally all changes impact their responsibility to keep the market informed.
You've had a long history with the Securities Commission, and this is all about building trust in Canadian capital markets, which is really rooted in investor protection. And we know that disclosure is really important. They want to make sure that investors get the right information at the right time. But it seems like something has been accelerated or changed through this Lundin case and how directors are supposed to look at this. How would you characterize that?
Pretend I'm sitting on a board, and how would this impact me? I would hope that the chief legal advisor to the board, the general counsel in the company, would come to either the board directly or to the governance committee and say, we've had this development at the Supreme Court of Canada level, and you need to know about it. As a director, my response would be, how does that impact me, my responsibilities? Do I do anything different? And I think we would then engage in a discussion about how the board itself would process the decision of the Supreme Court and its impact on how the board comports itself.
From your perspective, has anything really changed? I mean, there's always been, I would say, good disclosure, and some boards will tell you or directors will tell you there's been too much disclosure. We'll get into that in a couple of minutes. But there was something unique about what the Supreme Court of Canada was looking at. And they seem to be saying that material change, everybody knows you got to have immediate disclosure, but in some cases, material facts might in fact become material change. Is that what they're really driving at?
Just to talk about the environment in which this is happening, we live at a time where we are overwhelmed with information. We have to develop our skills to understand what information is reliable and what information is not reliable. I think all boards feel a responsibility to keep the market informed. They recognize the importance of, first of all, the valuation of their own stock, but also the efficiency of our capital markets depends upon a market that operates on reliable information, reliable and timely information. I think boards have always believed that. There may be a new dynamic foot here. We'll see. It elevates the responsibility of the board to make sure that the market is accurately informed. I don't see a cultural shift, but I do see every director understands their responsibility when it comes to keeping the market informed. And that responsibility has not been changed.
You mentioned accurate and timely. It seems like timeliness seems to get a little bit more attention in this particular case.
If you're a director or you're a CEO and something happens in, as we know, the business operations or capital of the company, that you have trouble assessing its impact. If you disclose whatever happened prematurely, you may be distorting the market's assessment of what's going on. As a responsible manager, director, you want to feel comfortable that the information that is being disclosed is reliable and accurate. How much time that takes will depend on the circumstances. It may be overnight or it may take a couple of days, but so long as you're operating in good faith, you recognize the urgency and you have to get on with it.
Let's unpack a little bit of that, because I know the director community is looking at this, and I think they're all asking the question, is this actually raising the bar on their legal obligations? I sit back and I think about the last 10 years of conversations with boards, and a lot of it has been about, let's focus more on foresight and strategy and less on compliance. And this seems to have a little bit of the, well, wait a minute, don't forget about this compliance piece. It's super important as well. I think the sense that I've got is that a lot of directors felt that they were acting quite responsibly in terms of the accuracy and the timeliness of this. What do you think is added to that conversation? Has this raised the bar for directors?
I don't think it's raised the bar of responsibility, the level of responsibility that the board experiences. I do think there's perhaps a greater sense of urgency and the need for boards to say, okay, if something negative happens in the business operations or capital of the company, how do we deal with it? Inform me as a director how the management and how the board, if it's involved, would deal with it. I think it has had an impact in making a director or sensitizing a director to his or her responsibilities for disclosure. But I don't think it's changed. I think the responsibility has always been there. And I think directors of public company understand that.
Where I want to go with this is on the impact on management too, because now boards are going to be looking at management and saying, okay, we've got this standard now it might be similar to what we had in the past, but maybe there's a little bit more urgency, to use your word here. Do we have management teams now scrambling to bring all sorts of possibilities forward to the board? Where does the board start to get a sense of what the right side of that line could look like? You're chairing that board. What would you say to your CEO?
I'd say, I want you to take a balanced view and understand the risks of premature disclosure and the risks of late disclosure when you're dealing with this issue. And then I want you to put yourself in the position of an investor and say, if I were about to purchase or invest in the company, should I have access to the information about whatever the internal development is? Or should I rely on management to wait until they've got a very precise assessment of the implications of the change for disclosure? And this is just about being sensible, understanding the importance of efficient capital markets, understanding the importance of investors making informed decisions, and understanding the need for corporations to operate in a functional way without being overburdened by regulation. And Rahul, I agree with you about this balance between overregulation and underregulation. In the current market in Canada, we're under new pressures emanating from the administration in Washington. I'm digressing a bit here, but I think boards of directors are hugely sensitive to the external environment, not just for trade reasons, but just generally, and sensitive to issues like sovereignty, democracy. Boards are thinking beyond the next quarter. They're thinking about the long-term sustainability of our markets. When it comes to disclosure, I mean, you can argue that if you're too late in disclosure, you're compromising the integrity of the market. If you're too early with the disclosure, you're compromising the integrity of the market. You got to get it right.
From one perspective, late disclosure seems obvious. You're going to run into some real legal difficulties there. Premature disclosure, maybe not so obvious. Let's talk a little bit about that. We've got some jittery management teams and jittery boards that look at this and say, well, look, when we evaluate this particular material fact, let's be safe and disclose. Let's get that out there. Let's talk a little bit about some of the downsides of that. Your potential of flooding the market with all sorts of extraneous information would be one, I would have thought.
An efficient market to discipline a company. If a company becomes known as a company that likes to manipulate its investors and other stakeholders through information disclosure, I think the company will ultimately pay a price in value. It may not happen instantly, but once you get a reputation, even a sense that maybe the company is trying to paint a picture that isn't as rosy as it really should be, then I think the company will pay a price in the value of its shares.
And how about the risk of sharing competitive information too early? Is that something the board should be concerned about?
Yes. I mean, the board's concerned about that generally. That's just one of the sort of themes that infect every director's thinking in every decision he or she makes.
That's in the context of competition, and that makes completely good sense. I'm also mindful that serving on a board, you don't want to create litigation risks. And on the one hand, you don't want to have too late disclosure because that creates risks and you could have class action suits coming out of that. And Lundin actually got them into that space in and of itself. But putting out information too early as well could create its own litigation risk. Is this the type of thinking that boards are going to need to start going through in a more detailed fashion?
I think every board should be thinking, as a result of the Supreme Court of Canada decision, just at the next board meeting, the board should be briefed and management should be briefed on the decision. And then the board should ask the CEO, okay, tell us what process we go through before we make timely disclosure of material changes, and understand that process and be comfortable that the process can't be abused or won't be abused to try to manipulate the market.
Do you think boards need a new playbook, or is the playbook that boards have been using up until now the right one?
They've got the right playbook. I'm not worried. I think the legal environment that creates corporations function because our legislatures have said we can create a body that can transact and it can attract capital that doesn't carry with it liability, and we can grow. And so corporations should recognize the great opportunity they have to grow, building capital from the markets. And the result is, I think, boards have a citizenship responsibility to contribute more broadly to the welfare of our country, our market.
So that's what the framework's supposed to drive and the outcomes. I get that. If you look at this case in particular, and it's still fresh in people's mind, what do you think's the big governance takeaway from this case? What should boards take away from the Lundin case?
The big governance takeaway is we have a fiduciary responsibility. We have a responsibility to act in the best interests of the company, and we better have a process in place that makes sure that our management of information internally and in the market is accurate and timely.
We talked about balance a couple of times. Do you think the Supreme Court of Canada got the balance right in this case?
That's a good question. The dissent in this case very eloquently talked about the implications of too much disclosure. The court, I think, had 9 judges. There was 1 dissent and 8 on the other side. So did they get the right balance? We'll see. We'll see how corporate Canada responds. I think corporate Canada will respond, as I say, by making sure that the processes internally really enable them to discharge their responsibility to make sure the market is informed on a timely and accurate basis.
You've mentioned fiduciary duty a couple of times and give a good outline on what directors should be doing. It's tough to have a conversation around something like this without talking about the business judgment rule. The way the courts, something we call defer to boards, provided they're acting in a non-conflicted manner, saying as long as you've done the homework, you've looked at the material, you've asked the right questions, we're not going to second guess you on that. How do you think the business judgment rule might be applied when looking at this type of disclosure? And where I'm going with that a little bit is it's safe and smart to defer to bad news early.
Well, the business judgment rule, I wondered if it would be possible for a board, if it was able to demonstrate to the court that its process for addressing the disclosure of information was thorough, unconflicted, well-advised, would that be the end of it? And I don't think that's the case. That may be the end of it when it comes to whether a board's made the right business judgment. Most courts won't interfere with the ultimate business judgment of a board if it is the product of an appropriate process. But when it comes to disclosure, boards should absolutely go through that process and make a decision that they might get it right or they might get it wrong. And if they get it wrong, all the process in the world won't help them.
This has been interesting because it's certainly not going to be the last word on Lundin. This is going to go back through the courts on the merits. Peter, maybe we'll reboot this conversation and we'll have a look at where this all lands. But right now, I'd say to our audience, get a chance to vote on this resolution now. And the resolution is, be it resolved, boards need a culture shift to bad news early to meet new disclosure obligations in this post-Lundin environment. Curious to know which way you'd vote. Peter, which way would you vote? We need a culture shift here, or do we have the right culture?
I'd vote no. I think the culture of a board is well established, and a process on how to manage information disclosure does not impact the overall culture of the board, of the corporation.
The current playbook is fit for purpose in your mind?
Yes. I've spent a lot of time in the last several years thinking about boards and how they respond to change. And my conclusion is that we have a legal framework that establishes board responsibilities, and we have legal processes that give stakeholders an opportunity to hold boards accountable for their decisions. I think this decision of the Supreme Court, as I say, is something boards have to revisit and be sure that their management of information is acceptable and consistent with their responsibilities. But a cultural shift, no.
Well, Peter, thanks so much for joining us today. We really appreciate getting the benefit of your experience. Look forward to coming back to it again, too. And to our listeners, I hope you enjoyed today's episode, Be It Resolved, and that you've deepened your boardroom insights to stay ahead of emerging trends. If you found today's discussion thought-provoking, we encourage you to subscribe and leave a review on your preferred podcast platform. From the Institute of Corporate Directors in Canada, I'm Rahul Bhardwaj. Until next time.